Hey everybody, Jake and Gino here, and today we're discussing the Federal Reserve raising interest rates and how this is going to impact you and your real estate investing strategy. So, G-Papa, what happened? March, the Federal Reserve announced that the Fed's target for the federal funds rate would increase by 25 basis points. The result will make it more expensive for banks to lend to consumers, leading to higher interest rates. So if you're like us and you currently borrow from Fannie, Freddie, you've already seen the 10-year Treasury jump significantly, and this has resulted in a full point increase in the loans that we're, so commonly and used to using for our multifamily properties. So why is this happening? Bottom line, too much government stimulus created too much money sloshing around in the system, and we are now seeing extremely high inflation. This is the Fed's move to reduce, aka fight the inflation. So, Papa Daddy Funk Master Flex. Mortgage rates are up. Now what?
That was a mouthful there, bro. I want everyone listening to it. Just click on a like button down below because I don't think I can get that out again. Subscribe to the channel, hit the like button because I guess I'm Papa Master Funk. I don't know. I'm just a guy with 6 kids trying to figure it out, everybody. And this economy has got me going crazy. We have not had a recession in 15 years. The whole decade from 2010 to 2020, there was no recession. That's never happened in history. I challenge everybody, go back to the Jake and Gino channel. Listen to Dr. Peter Linneman.
That was a great show.
Awesome show. Why am I referencing that show? What happens when the government, in their infinite wisdom, decides to print 25% of all the currency in circulation in the last 3 or 4 years? It goes to where? It goes to banks and it goes to governments. Now, the state governments have got their coffers filled and they're pulling these stupid programs. California is going to give $400 to every person because they got, gas prices are really high. Why don't you work on the problem, not the symptom of the problem, right? Let's try to lower the prices instead of giving money away.
Citizens are pissed because we got higher gas prices. Give them money.
Well, exactly. I'm sorry to divert the attention on the question that Jake answered, but it's for a broader perspective. So when we give money to these institutions, what do banks do? They lend to people who buy assets. There's a big appetite for the last 3 years, and that's why the residential and multifamily and self-storage have all elevated. Cheap money. The cost of capital has been so cheap. Now, people out there are saying, hey, well, now the cost of capital is rising. This may affect multifamily and other areas. Be very careful of what market you're in right now. There's something called supply and demand. Down here in St. Augustine, Florida, my house has doubled in 4 years. I don't really see it stopping for the next 6 to 12 months because there are so many people, aka New Yorkers and Californians, who are considering to leave their state
this is a pitch,
because of certain policies. And I'm just saying, listen, another show that we had with Ken Grombach, demographer, there is going to be 30 million Floridians by the year 2030. It's because people are getting older and, the acceleration of COVID, but there's a lot of policies that people don't agree with in certain areas and they're leaving, coming down here. They continue to come down. The price of homes is still going to go up because they're selling their $3 million home in New York and coming down here and buying $1 million home in Florida. So for them, it doesn't really matter if it's another point or a point and a half. Now, eventually that's going to catch up, but I don't know when. Just be careful of areas that are seeing population decline. There's less demand for the asset. What you need to do is how many days on the market for residential. And we're seeing other areas. A lot of our Jake and Gino students, big shout out to them, over 35,000 units closed to date, and they're rocking it. They're seeing earnest hard money day one going bye-bye. They're seeing financing contingencies in contracts now. That hasn't been a thing for a while. You're starting to see the cracks. You're starting to see the cracks. I actually had a student who said we had to do a dry close. I don't know what a dry close was. I mean, I had no idea what that was.
They're not bringing any money?
Well, and to close early because the debt markets are going crazy. They don't know what's happening. All of a sudden, debt's going crazy. And Creative Cash, PDF copy, hit me up, Gino@jakeandgino.com. Seller financing and creative financing solutions are going to come sooner or later. It's going to happen. I think sooner because the debt markets are so volatile and interest rates are going to rise. And the irony is in a recession, as we're going into one, we typically lower rates. We can't do that. We're doing the opposite, which is amazing to me. No one's really discussing it. We're raising rates as we're going into recession. That's going to hurt the economy even more, make slow prices down, but it's going to, I think, ultimately create some type of stagflation and really demand for products. Housing ultimately in a lot of areas, even Florida, it's going to have to slow down. If we can't borrow money cheaply and the cost of capital is more, it's going to affect the entire economy, not just real estate itself.
I'm going to translate what the G-Father just said. if you're in a growth market right now where there's still people flooding to an area where there's not enough supply and there's a lot more demand, GDAD is bullish on asset prices in those markets. If you're in a market where you're not seeing a significant population job growth, the GDAD saying, be careful, do not overpay in those areas. Make sure you're getting cash on cash from day one. Mm-hmm. Now, what about the folks that have used aggressive bridge debt in the last 24 months? Do you think there's risk there, and how do you see that playing out?
Jake, we've been talking about this for the last 3 or 4 years. A lot of our students were using bridge debt 3 or 4 years ago, and I expected rates to rise. I didn't know COVID was coming. I didn't know they were going to slam the brakes and decide to keep rates so low. Now they have no other option. There's more quantitative easing. Fed's not buying back any of this debt. And as rates rise, if you're locking in rates at 3.5%, 4%, even 5% right now on bridge debt, let's say we're going loan to cost with our community banks, so we're getting lower rates. But I know with the agency, as far as bridge debt, it's pretty high right now. And I would caution people when they're using bridge debt, read the fine print. Pricing is exorbitant.
Great point.
1% origination fee. And I'm going to save you a ton of money on this show as you're listening to this. On the back end, when you refinance it out, read the fine print. Are they charging another percent with the same lender, and you have to use the same person? The answer is probably yes. So be very careful.
They're getting 2 loans out of you, is what Gino's saying. They're going to get this one, and then they expect to get the next one. So you got to be, very cautious there. Yeah.
And if you're underwriting a deal and you got bridge debt at 5% interest only today, well, when you're going to refi that out 24 months from now, I can almost guarantee you we'll go back 2 years from now. Rates are probably going to be around 5%. So if you're underwriting your deal at 3.5 or 4, but in your exit 2 years from now, when you're rolling that out, you're going to get a 5% loan. That is going to hurt your underwriting.
Better perform from a management perspective.
Yeah, Jake, we've been safe for the last few years because even though you're paying higher in your rates as you were a year ago, rents have risen so dramatically over the last 24 months that people in their infinite stupidity have been actually bailed out of it. I don't see rents going up 20% in the next 2 years. And if they do, I'll be wrong, but I don't want to take that risk. It's buy right, manage right, and finance right. We're talking about buy right now. And we're also talking about the finance right portion. So be very careful about your bridge debt going in today. Make sure you have a quick plan. Supply chain issues are making these things go longer than 24 months because you can't get the supplies in. Labor is a little bit difficult. Hopefully by the end of the year, things break up, but I don't know. So just be careful with bridge debt going in on the front end and make sure you underwrite conservatively for rent growth, and make sure you underwrite conservatively for those interest rates going up because they're going to go up.
Yeah, and that's why we are stodgy, boring, long-term buy and hold investors. Now, what do I mean by that? We want to take the interest rate risk off the table. So we do buy many times with community banks on the front end in a similar fashion to what bridge debt is, but we're locked in for a minimum of 5 years. We do loan to cost on the front end. We renovate the product. And then when the timing is right, we have a short prepayment, 1 to 2 years off the table. So in years 2 through 3, we wait till we think the timing is right. And then we send it out to pasture. What I mean by that, we send it out to Fannie Freddie for a 10, or plus long deal. And we take the interest rate off the table for a long period of time because we want to sleep at night. We don't want to worry about these fluctuations. Yes, I have some debt right now in the mid 4s from, a couple of years back. And people are like, well, you could have gotten the 3s. It worked at the time very well. And now with, the rental rate increases, it's absolutely killing it. I'm fine. I'm not into these floaters. I know a lot of people want to do the Freddie floaters. They're in and out. When you're holding for the long term, I recommend taking on long-term fixed rate debt to take the risk off the table. And what does that allow us to do? We hone in, buy right, manage right, finance right. We bought it. We financed it for long-term. Okay. We bought it right, financed it right, long-term. Now we hone in on the one thing that can drive revenue at that point, manage right. We work on our management systems. We make sure our folks are getting the resources that they need. We're making tweaks on a weekly basis. We're on these calls with our management team, doing what we can to drive the NOI from the management perspective. And Gino says this all the time. The number one key when you're buying deals is that no deal is better than a bad deal, because if you get one of these deals that doesn't work from a cash on cash perspective, you're never going to be able to basically make, positive cash flow on it. It's a deferred maintenance nightmare. It's going to make your life miserable. You're going to question yourself, why the hell did I become a multifamily investor? But if you wait for your pitch, you get the right deal and you start stacking a lot of those right deals on top of each other. It could be 2 to 3 a year. Life's going to be good from a cash flow perspective. And that's what we preach. Gino.
Jake, let me just give the listeners, I guess, a tip. We talk about the three pillars of real estate with market cycle and the conveyor belt. The conveyor belt theory, we want to stack assets on the conveyor belt. What I want you to do is, we are notoriously, as humans, short-term creatures. What I want you to do is to extricate yourself and picture and imagine that you're high above, looking down at yourself right now. And think out 3-5 years. Because right now, all of us are saying to ourselves, the market's at a high. Market's been at a high for the last 3 years. I can't find any deals. It's okay. The market cycle will shift and will change. We're seeing those shifts right now. Stay in the game. Think positive. Think long-term, the 100-year mindset. That's what you're geared to. This person up here that you just pulled yourself out of, you're looking down here. Don't worry about what's going to happen tomorrow, the next month, 3 months, 6 months. You're going to get a deal within the next year. I can promise it. If you continue to work hard, you continue to network, you continue to get out there and underwrite deals, continue to create relationships, start raising the capital from the investors. There's so many things you can be doing other than just deal flow right now. And that's the problem. People are just focused on getting deals. And then all of a sudden their mojo, their state drops and they go, I can't find any deals. Don't worry about that. They're going to come, the deals. There's so many other things you can do at the same time. Keep doing those other things. Keep thinking about where you want to be in the next 3 to 5 years, but do those actions today. And you need to be part of a mastermind. You need to be part of a group that is actually elevating you, that's surrounding yourself, and they're having the same issues as you are, because you're not the only one out there. If you're on an island right now by yourself going, there's no deals out there. Well, guess what? There's a lot of people out there who have that, but getting around with people, trying to network and partner with others, doing a JV deal, doing a small deal, get that deal on that, what we call that imaginary conveyor belt. And that deal will start matriculating after a year, 2 years, 3 years. All of a sudden you have a refi, a sale, and there's a constant motion, cash flow to equity, back to cash flow and back to more equity. That's how it gets done. But like I said, pull yourself out and see yourself 3 years from now. This is just a funky part of the market cycle. It's called the market cycle because there are cycles, and we're going to be cycling out of this one soon.
And we did 2 deals last year. We had like 6 going on in the last 4 months. It just depends. And that's why you got to be patient. When it's there, you jump. And sometimes they all come at once and it's like, it's crazy, but you got to take them when they come. And that's how it goes. So I completely agree. Play for the long term. Can we see the book again?
Yes.
You're giving away. Yep. There we go. Creative Cash, the GDAD, Gino at jakeandgino.com. Send it over and he will send you a free copy.
Subscribe and like down below. Leave us a comment. Tell us what's going on. I want to know, more importantly, what you guys think about what's going on with this interesting environment, because it's just Jake and myself talking. We're talking to other thought leaders, but there's no real experts out there. If someone thinks that they're an expert, it means they've lived hundreds of years and they've gone through every single market cycle. Every single market cycle is different. So we'd love to hear your thoughts and opinions on what's going on in this part of the market cycle.
Amen, brother man. I'm Jake. He's the G Daddy, and we will see you next time.